Welcome back, everybody, to another deep dive. We've gotten a ton of questions lately about financial predictions.
Oh,
People want to know, can anyone really predict the future of the markets?
right.
Well, let's dive in and see what we can find out.
It's a fascinating question, and honestly, it's one that has puzzled investors probably, since the beginning of markets.
So, absolutely. I mean, who wouldn't want a crystal ball telling them, exactly how the market's going to perform?
Right. Especially when it comes to their own money. And the
Totally.
source we're looking at today really gets into kind of the psychology of why we're so drawn to these confident predictions we see everywhere.
Yeah. The source uses this great phrase, cifras milimétricas y titulares llamativos, which basically means exact figures and flashy headlines to describe how these predictions are packaged.
Yeah, exactly. It's all about that illusion of certainty.
Yeah.
But as we're about to see, the reality is much more nuanced.
Way more nuanced. So, okay, let's talk about the elephant in the room. We've all heard about this average market return, right?
Oh yeah, the good old reliable.
Yep, the S&P 500 historically returns an average of 7.9% each year. Sounds pretty solid, right?
It
It's like,
does.
why would we even bother trying to predict anything else? But then the source hits us with this crazy statistic. Over the last 96 years, the actual return has only fallen within that seemingly reasonable 5 to 10% range a measly 6 times.
Yeah, that's surprising.
6 times out of 96. That's mind-blowing.
It really highlights how misleading that average can be.
Yeah.
It makes it seem like growth is all smooth and predictable when in reality it's anything but.
So, okay, if this average is so unreliable, why do we even use it? Why are analysts making all these predictions based on something that's practically guaranteed to be wrong most of the time?
Well, it's interesting. The source suggests it's often about managing expectations and honestly a bit of self-preservation, career risk. I mean, it's a lot safer for an analyst to kind of cluster around that average, even if it's not accurate, than to make a bold prediction that ends up being, spectacularly wrong.
So they're basically choosing to be, well, wrong, but not that wrong.
Right. It's like they're more concerned with not making a big mistake that could hurt their reputation than they are with being accurate.
Interesting. So it's like this whole industry is built on this foundation of sort of cautious guesswork rather than real insight.
Yeah, it's kind of cynical, but the source really drives this point home with some pretty, hilarious examples of some spectacularly wrong predictions.
I love this section of the source. Talk about a walk down memory lane. It's like a greatest hits of bad calls. Like economist Irving Fisher, who, right before the 1929 crash, confidently declared that the stock market had reached a permanently high plateau. Oops.
Yeah, that's like legendary for its inaccuracy. It just shows how even, really experienced experts can fall prey to maybe groupthink or just get carried away by the prevailing mood and miss those potential risks.
For sure. And then there's Goldman Sachs. They predicted oil would hit, what was it, $200 a barrel back in 2008?
Right in the middle of the financial crisis.
And instead, it plummeted to under 50.
Yeah, it's a good example of how tough it is to account for those black swan events, right? Like those things that nobody sees coming
Right.
and just completely throw off all the forecasts.
Black swan events. I like that. Okay, so we've got economists, investment banks, and then there's John McAfee, our favorite software mogul,
Oh boy, yeah.
predicting Bitcoin would hit $1 million by, what was it,
I
2020?
think so. And thankfully for him, he didn't have to follow through
Well,
on his rather bold wager on that prediction.
that's a whole other story. Okay, but the point is, all these examples show how tough it is to predict the market with any real accuracy. And what's even more fascinating is the source also points out that big market swings, those crazy ups and downs, they actually happen more often than we think. So why, if these extremes are kind of a regular part of the market, why are they so rarely predicted?
Hmm. Well, I think it circles back to what we were saying earlier, that desire to stay close to that average, even though, as we've seen, that average is, well, not that reliable.
Yeah. It's like analysts are so afraid of being wrong in a dramatic way that they end up missing the really big shifts that are happening.
Exactly. Playing it safe, maybe a little too safe.
Mm.
So what does all of this mean for you, the listener? What can we learn from all this? That's what we're going to be discussing in part 2 of our deep dive.
So we've seen that predicting the market is basically, well, impossible. You can't rely on averages, and even the experts get it wrong, like all the time. So where does that leave us? Like, if we can't predict the future, how do we even make good decisions about our money?
Yeah, That's the big question. And I think the source makes a really interesting point here. It says that instead of trying to, like, outsmart the market, we should really be focusing on, the fundamentals of sound investing, the things that actually work over time.
Okay, I like that. Embracing the fact that we can't predict everything.
Exactly. Unpredictability is built in. Yeah.
Yeah. So, what are these timeless principles, the things that actually stand the test of time?
Well, the source really makes a strong case for, the classics: diversification, low costs, and patience. It might not sound as exciting as, like, chasing the hottest stock tip,
Right.
but it's what really builds wealth over the long term.
Okay, so let's break those down a bit. Diversification, that's basically don't put all your eggs in one basket, right?
Yeah.
Spread your investments around to reduce risk.
Exactly. Diversification is like a safety net. If one part of your portfolio is down, another part might be up.
Gotcha. And low cost, that's all about minimizing fees, right? So those fees don't eat into your returns over the long haul.
Right. It seems pretty basic,
Yeah.
but you'd be surprised how many people don't pay attention to fees.
Mm.
And over time, they can make a huge difference.
Yeah, fees can really sneak up on you. And then there's patience, which honestly, for me at least, is probably the hardest part.
Oh, yeah, I agree.
Like, it's really hard to stay calm when the market is going crazy, and you
Yeah.
see all these other people making like these risky bets and maybe getting rich quick.
It is, and that's
Yeah.
where that temperament we were talking about comes in, right? Like,
Yeah.
some people can handle that volatility better than others.
True. The source really emphasized the long game, though. You have to be willing to ride out those short-term ups and downs and just trust that over time, things will balance out.
Exactly. It's a marathon, not a sprint.
I like that. Okay, this all makes sense, but I gotta say, it does feel a bit passive. Like, don't get me wrong, diversification, low costs, patience, they're all important. But are there any, strategies, tactics that we can use to maybe, help boost our chances of success?
Yeah, of course. And the source isn't saying that you should just, like, throw money in the market and hope for the best.
Yeah.
There are, tons of different approaches to investing. The key is to find one that works for you, for your risk tolerance, your goals,
Right, right.
and, like we said, your temperament.
You keep mentioning temperament. What exactly do you mean by that?
Well, it's really about knowing yourself as an investor. Some people love that, like, thrill of day trading,
Yeah.
constantly buying and selling.
Yeah.
Others are way more comfortable with that long-term kind of set it and forget it approach.
Right. So it's not just about picking the right investments, it's about picking the right strategy overall.
Exactly. Like, how do you react to risk? How do you handle those ups and downs? Those things can make a huge difference in how successful you are as an investor.
Okay, that makes sense. So we've got diversification, low costs, patience, and, picking an approach that actually works for us. Anything else we should be keeping in mind?
The source talks a lot about the importance of learning, like really being a student of the market.
Right, it's always changing.
Yeah. So you have to, like, stay informed, keep up with those new trends and technologies and potential risks, that kind of thing.
So reading articles like the ones our listeners sent in.
Exactly. Listening to podcasts like this one.
That's right. The more you learn, the better you'll be able to make those smart decisions.
And not just rely on someone else's predictions.
Right.
Okay. So we've covered a lot here. Debunked the myth of market predictions, explored the limitations of averages, and, laid out some key principles for building wealth over the long run. What's the one big takeaway you want our listeners to walk away with? I think the biggest thing is that the market is, at its core, unpredictable.
Yeah.
But instead of letting that freak us out, we can actually embrace it. We can focus on those things we can control, like building that solid foundation, diversification, low costs, patience, and always keep learning.
No crystal ball needed.
Exactly.
Love it. But this whole discussion about averages and the long-term nature of investing brings up another question. Like, if we can't rely on those traditional benchmarks, how do we even go about evaluating potential investments in the first place? What should we be looking for?
That's a great question. And one that deserves its own deep dive.
So we spent a lot of time talking about how those market predictions are, well, often wrong. And even those average returns can be super misleading.
Right.
But that kind of leaves us with a big question. If we can't rely on those traditional benchmarks, how do we even start to figure out if an investment is good or not?
Yeah, that's a great question, and it's where things get really interesting. One approach that a lot of people find helpful is to shift their focus away from trying to time the market, perfectly,
Okay.
and instead try to understand the underlying value of a company or an asset.
So it's like less about those short-term price swings.
Exactly. It's more about, the fundamentals, digging a little deeper.
I like that, taking that longer view. So what kind of things would we actually be looking at?
Well, you'd be thinking about things like the company's financial health. Do they have any competitive advantages?
Right.
How strong is their management team? What's their overall growth potential?
That sounds a lot like value investing, right? Finding those companies that are maybe a little bit undervalued by the market.
Yeah, that's a great way to put it. Value investing is all about trying to find those hidden gems. The companies or assets that are trading for less than they're actually worth.
It's like being a detective. But how do you actually figure out a company's true worth? There's so much information out there, it's hard to know what to trust.
Yeah, it definitely takes some work. You've got to analyze those financial statements, understand what's going on in the industry, see who the competition is. It's all about doing your homework, really.
So you're not just blindly following the crowd.
Nope. You're forming your own conclusions based on, real research and analysis.
Okay, value investing makes sense. But are there any other approaches out there that we should know about?
Of course. There's another popular approach that a lot of people are drawn to, growth investing.
Growth investing. So that's not about finding the undervalued companies.
It's about finding those companies that are expected to grow really fast, above average rates.
So you're kind of betting on the future, believing those companies will continue to innovate and kind of, take over their markets.
Exactly. You're looking for those companies with, massive growth potential.
Yeah.
Even if their current valuations seem high.
Right. But growth can be, well, kind of hard to predict, can it? How do you know which companies will actually be able to keep growing like that?
Yeah, that's the tricky part. You have to really look at their business model. How sustainable is it? What advantages do they have over their competition?
Right.
And it's always good to see what their management team has done in the past.
Yeah.
You're trying to figure out if their growth is like, the real deal
Mm-hmm.
or if it's just hype.
So both value investing and growth investing, each with its own things to consider. Are there any other big investment philosophies that, we should know about?
Oh, absolutely. There are tons. Some people love dividend-paying stocks.
Mhm.
Others are into real estate or commodities.
Okay.
Some people love actively managing their investments, always buying and selling. Others prefer to just kind of set things up and let them ride.
So it's like a whole world out there.
There really is. The key is to do your research, and find an approach that you're comfortable with that fits your risk tolerance, your goals, and, well, like we keep saying,
Our temperament.
yes, you've got to be able to sleep at night. Investing isn't just about numbers and spreadsheets. It's also about, how you feel about risk, volatility, that kind of thing.
So it's about finding that sweet spot where your financial goals meet your personality.
Exactly. That's where the magic happens.
We've covered so much today. It's been amazing. We've debunked those market predictions, learned about the limitations of averages, and talked about some, really key principles for investing success. What's the one thing you really hope our listeners take away from this deep dive?
Honestly, I think the most important thing is to remember that the market is, at its heart, unpredictable.
Yeah.
But we don't have to let that scare us.
Right.
We can choose to see that unpredictability as an opportunity and, just focus on building that strong foundation. Always be learning.
No crystal ball needed. Just a little curiosity and a willingness to learn and adapt.
That's it.
Well, on that note, I think we're going to wrap up this deep dive into the world of investing. Always fascinating and, sometimes a little bit wild. We hope you've enjoyed the journey.